Right now, somewhere in a glass office you'll never step foot in, a bond trader just made more money in the last 10 minutes than you'll make this entire year. And you don't even know his name. Because while you were taught to fear debt, the elite were taught to become the debt. That's what a bond actually is. It's not some boring line item your dad glossed over at the dinner table. It's the machine that decides your mortgage rate, your government spending power, and whether your currency is worth anything by next year. In 2026, the global bond market moves somewhere around $130 trillion. Trillion with a T, the stock market you obsess over, the one you check on your phone in the bathroom at work. A fraction of that. You've been playing checkers in a casino built for chess, while the house quietly runs the real game in a room you were never invited into. And in the next 25 minutes, I'm handing you the rulebook they never wanted you to read. Let's actually name what's happening, because most financial content dances around it instead of saying it directly. Here's the lie. And it's not a small one. You've been told your whole life that safe investing means stocks for growth and maybe a savings account for stability. Bonds are what your grandfather bought. Bonds are boring. Bonds are for old people who don't understand risk. That's the story. And it's a story that keeps you exactly where they want you. Confused, uninvested, and dependent on a paycheck that inflation is quietly eating alive. Because here's what nobody tells you. Bonds aren't boring. Bonds are the actual foundation of the entire financial system. Every mortgage you'll ever take out is priced off the bond market. Every high-interest savings account you're proud of is really just a bank borrowing your money cheap and lending it out through instruments that trace straight back to bond pricing. Every time the news says the Fed raised rates, what actually happened is the bond market repriced, and everything downstream, your car loan, your credit card APR, your company's ability to hire, shifted with it. And the people who run this system, they don't fear bonds, they live inside them. Pension funds, insurance companies, sovereign wealth funds, central banks, trillions of dollars move not because of vibes or hype, but because of yield, duration, and credit risk. Words you were never taught. Words that, once you understand them, change the way you see every financial headline for the rest of your life. This isn't a fringe topic for finance nerds. This is the operating system underneath the operating system. Stocks get the headlines because stocks are emotional. Green candles, red candles, a number you can watch swing in real time and feel something about. Bonds don't give you that dopamine hit, so the entertainment machine that is financial media mostly ignores them, or reduces them to a single confusing chyron that scrolls by in 3 seconds. But the size difference alone should tell you something is deeply wrong with where your attention has been pointed your entire life. The lie isn't that bonds are boring. The lie is that you don't need to understand them. You do. Because if you don't understand bonds, you don't understand interest rates. And if you don't understand interest rates, you don't understand why your rent went up, why your job got harder to find, why your business loan got denied, or why the recession everyone keeps whispering about might already be baked into numbers you've never bothered to look at. Think about who benefits from you staying confused. It's not some shadowy cabal twirling a mustache in a back room. It's simpler and more mundane than that, which is exactly why it works so well. Complexity is profitable. Every layer of jargon between you and a clear understanding of how your money actually moves is a layer where someone else gets to charge you a fee, sell you a product, or quote, you a rate you have no ability to question. The financial industry doesn't need to actively lie to you. It just needs you to stay one step behind. Forever, nodding along at words like yield and duration without ever asking what they actually mean for the number leaving your bank account every month. That's the entire business model of financial illiteracy, and it runs on autopilot generation after generation unless someone actually sits down and breaks it apart for you in plain language. That's what we're doing right now. Before I break this down point by point, and I mean actually break it down with real math, real scenarios, no fluff. If you want more of this, the kind of financial literacy that actually gets withheld from you on purpose, hit subscribe right now. And tap that like button. It tells this channel to put more of this in front of more people who need to hear it. Deep strategy breakdown. Point 1. A bond is just a loan, and you're already losing money because you don't know that. Strip away the jargon. A bond is a loan. That's it. That's the whole concept underneath every complicated headline. When a government or a corporation needs money, they don't just print it or beg a bank, they issue a bond. You, or an institution, buy that bond, meaning you loan them money. In exchange, they promise to pay you back the full amount on a set date, called the maturity date, and pay you interest along the way, called the coupon. Here's where it gets real. Say the US government issues a 10-year treasury bond with a face value of $1,000 and a coupon rate of 4.5%. That means you hand over $1,000 today. And every year for 10 years, you get $45 in interest. At the end of the 10 years, you get your original $1,000 back. Simple, right? Except here's the part that separates people who build wealth from people who stay confused forever. Bond prices move in the opposite direction of interest rates. When rates go up, existing bond prices go down. When rates go down, existing bond prices go up. Let's do the actual math, because this is where most people's eyes glaze over. And that glazing over is exactly why they lose money. Say you bought that $1,000 bond paying 4.5%. A year later, the Federal Reserve raises rates, and now brand new bonds are being issued at 6%. Nobody wants your old 4.5% bond anymore when they can get a fresh one paying 6%. So the market price of your bond drops maybe down to $850 until the effective effective yield an investor would get from buying it at that discount and holding it to maturity roughly matches that 6% new issue rate. You didn't lose your money to a scam. You lost it to math you never learned. Now flip it. Rates drop to 3%. Suddenly your old bond, still paying that fat 4.5%, looks incredible compared to new bonds only paying 3%. Demand spikes, your bond's price might climb to $1,150. You could sell it for a profit before maturity, or just hold it and enjoy collecting an above-market rate. This is the psychological root cause of why 90% of people avoid bonds entirely. They feel like a black box. Stocks feel intuitive, company grows, stock goes up. Bonds feel abstract, a percentage moving against another percentage in a direction that seems to defy common sense. Your brain, wired for simple cause and effect, rejects the inverse relationship instinctively. That rejection isn't stupidity. It's cognitive friction. But friction you avoid is friction that costs you money, because bond price movements are exactly what's driving the mortgage rate quote you got last month, the too expensive feeling in the housing market, and the reason your landlord raised your rent to cover his own refinancing costs. The practical, non-obvious execution rule here. Stop asking will interest rates go up or down. Start asking what is the bond market already pricing in? Bond prices move on expectations, not headlines. By the time the news announces a rate cut, the bond market has usually already priced most of it in weeks earlier. If you want to understand where the economy is actually heading, stop watching pundits shout on TV and start watching the 2-year and 10-year Treasury yields move week over week. That's the real scoreboard. Everything else is commentary. And here's the piece that really separates the amateurs from the people who actually make money on this stuff. Duration. Duration measures how sensitive a bond's price is to a change in interest rates. A bond maturing in 1 year barely flinches when rates move. A bond maturing in 30 years can swing violently on that exact same rate change because you're locked into that fixed payment for 3 decades instead of 12 months. Picture 2 bonds, both paying 4.5%. One matures next year, one matures in 2056. The Fed hikes rates by a full percentage point. The short bond might drop 2 or 3% in price. The long bond could drop 15, even 20%. Same coupon rate, same issuer. Completely different outcome, purely because of how long your money is locked up. This is why professional bond investors obsess over duration risk, the same way a poker player obsesses over pot odds. It's not a side detail, it's the whole game. And it's also why so many regular investors got blindsided in recent years when they bought what they assumed was a safe long-term government bond fund, only to watch it drop double digits in value the moment rates climbed. Nobody explained duration to them. They heard government bond and translated that in their head to can't lose money. That assumption cost people real, painful losses, not because bonds themselves are dangerous, but because nobody ever taught them the mechanism sitting underneath the label point 2. The yield curve is the closest thing to a financial crystal ball, and it's sitting in plain sight. This is the part that should genuinely unsettle you. There is a single chart, freely available, updated constantly, that has correctly signaled every US recession for the last 50 years, with only one real headfake in that entire span. It's called the yield curve, and almost nobody watches it, because almost nobody was taught what it means. Normally, longer-term bonds pay higher interest than short-term bonds. That makes intuitive sense. If you're locking up your money for 30 years instead of 3 months, you deserve to be compensated more for that risk. And that weight, that's a normal yield curve sloping upward. But sometimes, short-term bonds start paying more than long-term bonds. The curve inverts. And when that happens, it means the market is betting that the economy is about to slow down hard enough that the Federal Reserve will be forced to cut rates significantly in the future, which pulls long-term yields down relative to short-term ones. Investors are essentially saying collectively with real money, something's coming. Let's put a number on this so it's not just abstract theory. In mid-2022 through 2023, the 2-year Treasury yield rose above the 10-year Treasury yield, an inversion, and it stayed inverted for an unusually long stretch. Historically, when that specific inversion happens and then normalizes again, meaning it uninverts, that's frequently the closer signal to an actual recession starting, not the inversion itself. This is the kind of nuance nobody explains to you, because explaining nuance doesn't get clicks. What gets clicks is screaming recession incoming every time the line dips below zero. Here's the psychological trap at play. Humans are pattern-matching machines who crave certainty. A yield curve inversion feels like it should predict the exact month of a crash. It doesn't. It's not a stopwatch, it's a smoke detector. It tells you there's smoke. It doesn't tell you exactly when the fire reaches the ceiling. Historically, the lag between inversion and actual recession has ranged anywhere from 6 months to over 2 years. People who treat it as a precise countdown clock panic sell too early, miss out on continued gains, and then blame the indicator for being wrong, when really they misunderstood what the indicator was for. The non-obvious execution rule. Don't use the yield curve to time an exact market crash. Use it as a risk dial. When the curve is deeply inverted, that's your signal to shift your posture. Build more cash reserves, Reduce exposure to companies with heavy variable rate debt, and start paying closer attention to your own personal balance sheet because tighter credit conditions historically follow. It's not a sell signal, it's a get your house in order signal. The elite don't panic when they see this. They quietly de-risk while everyone else is still arguing on social media about whether a recession is real. Let's also talk about why banks specifically care about this so much, because it filters straight down to whether you can get approved for a loan at all. Banks make a huge chunk of their profit on something called the net interest margin, the gap between what they pay depositors and what they charge borrowers. Banks generally borrow short-term through deposits and lend long-term through mortgages and business loans. When the yield curve inverts, that spread compresses, sometimes to almost nothing. Suddenly, lending isn't as profitable, so banks tighten their standards. Credit gets harder to access, not because you got riskier as a borrower, but because the entire lending business model got squeezed by a curve most people have never looked at. That's the invisible thread connecting a chart on a financial terminal to the loan officer telling you not approved. 18 months later, it's not politics. It's not your fault. It's mechanics. Point 3. Bonds are the reason your mortgage rate feels insane, and almost nobody connects the dots. This is the point where this gets personal, because this is the piece of the puzzle that's actually been draining money out of your life directly, not theoretically. Mortgage rates are not set by your bank looking at your credit score and picking a number that feels fair. Mortgage rates are priced primarily off the 10-year Treasury yield, plus a spread that accounts for prepayment risk and credit risk. When the 10-year yield moves, mortgage rates follow, usually within days. Let's run the real math on why this matters more than people realize. Take a $400,000 mortgage at a 3.5% interest rate over 30 years. Your monthly principal and interest payment is roughly $1,796. Now take that same $400,000 mortgage at a 7% interest rate, a level we've genuinely seen in recent years. Your monthly payment jumps to roughly $2,661. That's an extra $865 a month every single month for 30 years for the exact same house. Over the life of the loan, that difference adds up to over $300,000 in additional interest paid. Same house, same neighborhood, same walls. A completely different financial outcome purely because of where bond yields happened to sit the week you signed your paperwork. This is why timing and understanding actually matters, and it's not gambling, it's math. When the 10-year yield spikes because the bond market is pricing in stubborn inflation or heavy government borrowing, mortgage rates spike with it. And suddenly, the exact same house becomes functionally 30 to 40% more expensive on a monthly basis. Home affordability didn't crash because houses got worse. It crashed because the bond market repriced risk. The psychological root cause of why people miss this connection is what behavioral economists call proximate cause bias. Your brain blames the thing right in front of it. The bank, the loan officer, greedy lenders, instead of the invisible mechanism 3 layers back that actually set the price. It's easier to be angry at a person than to understand a market. But anger doesn't lower your payment. Understanding might change your strategy. The practical execution rule: if you're planning a major purchase tied to interest rates, a home, a car, a business loan, track the 10-year Treasury yield the way you'd track weather before a road trip. If it's climbing sharply, financing costs on everything are about to get more expensive across the board, and locking in sooner rather than later, or restructuring toward shorter-term debt you can refinance later, becomes a real strategic move instead of a guess. If yields are falling, patience might actually save you tens of thousands of dollars. This isn't speculation. This is reading the same scoreboard the professionals read, instead of waiting for your loan officer to hand you a number and calling it fate. There's a second layer here that almost nobody talks about, and it's called the mortgage spread, the gap between the 10-year Treasury yield and the actual mortgage rate you're quoted. That spread isn't fixed. It widens when lenders perceive more risk in the housing market, more prepayment uncertainty, or more general economic stress, even if the 10-year yield itself hasn't moved much. In calmer periods, that spread might sit around 1.5 to 1.7 percentage points above the 10-year. In stress periods, it can widen to 2.5 or even 3 points, adding real cost on top of whatever the underlying Treasury yield is doing. So when you hear the Fed didn't even raise rates, but my mortgage quote still went up, this spread widening is usually the hidden culprit. It's not your credit score. It's not your lender being greedy. It's the market pricing an extra uncertainty on top of the baseline. And almost nobody outside the industry ever gets that explained to them in plain language. Point 4. Government debt, bond auctions, and the uncomfortable math of who's really paying for this. Here's the part that gets uncomfortable, because it's not about your personal finances anymore. It's about the system all of our personal finances sit on top of, whether we like it or not, whether we ever bothered to learn it or not. Governments fund themselves largely by issuing bonds. The US Treasury holds regular auctions, selling bonds to investors, banks, pension funds, foreign governments, and yes, regular people to cover the gap between what the government collects in taxes and what it spends. As of 2026, U.S. national debt sits north of $35 trillion, and a meaningful chunk of the federal budget every single year goes not toward roads, healthcare, or defense, but simply toward paying interest on existing debt. Here's the math that should actually concern you. If the government is running with, say, roughly $1 trillion a year just in interest payments, that money isn't building anything. It's not a hospital, it's not a bridge. It's a check written to whoever's holding the bonds purely because debt was issued in the past. And as older, lower-rate bonds mature and get replaced by new bonds issued at whatever the current, potentially higher rate is, that interest burden can compound in a way that's structurally difficult to reverse quickly. This connects directly to something called bond vigilantes, a term for large-scale bond investors who, when they lose confidence in a government's ability to manage its debt responsibly, start demanding higher yields to keep lending. When that happens, borrowing gets more expensive for the government itself, which increases the interest burden further, which can spiral. We've watched versions of this play out in other economies over the past several years, and it's a mechanism worth genuinely understanding rather than dismissing as just politics. The psychological trap most people fall into here is what I'd call scale numbness. Trillion-dollar numbers stop registering as real because they're too big to emotionally process. Your brain can feel the difference between a $20 and a $40 dinner bill. It cannot feel the difference between 30 trillion and 35 trillion in national debt. That numbness is exactly why this topic gets ignored by the general public, while it's tracked obsessively hour by hour, minute by minute by every serious institutional investor on the planet, because they know exactly what a single decimal point shift in a number like that translates into once it compounds across a portfolio worth billions. The non-obvious execution rule for you personally: you cannot control government debt levels, but you can control your own exposure to the consequences of it. Elevated government borrowing tends to put upward pressure on interest rates broadly, because the government is competing with everyone else for the same pool of lenders. That means in higher rate environments driven partly by heavy government issuance, holding excessive variable rate personal debt becomes more dangerous, while owning some fixed rate debt you locked in earlier becomes more valuable. Understanding the macro picture isn't about predicting doom. It's about correctly pricing your own personal risk instead of being blindsided by it. Think about it this way, and this is the mental model I want you to walk away with. The government, corporations, and households are all competing for the same finite pool of lendable money in the bond market at any given time. When the government dramatically increases how many bonds it's issuing to cover its deficit, it has to offer more attractive yields to pull enough buyers in, especially if existing buyers are already sitting on large positions. Those higher yields on government debt then become the new baseline that corporate bonds, mortgage bonds, and every other form of borrowing gets priced against. Because why would any investor accept a lower yield on a riskier corporate bond when a safer government bond is suddenly paying more? This is sometimes called crowding out, and it's one of the quieter reasons rates can stay elevated even when a central bank isn't actively hiking. It's supply and demand just playing out in a market most people have never once thought to look at, despite it sitting directly upstream of their own monthly bills. Point 5. Why bonds belong in your portfolio, even though everyone told you they're for old people. Let's kill this myth directly because it's cost an entire generation real money. The idea that bonds are only for retirees playing it safe misunderstands what bonds actually do in a portfolio. Bonds aren't there because they're exciting. They're there because they behave differently than stocks, and that difference is the entire point. Here's a real scenario with real numbers. Say you have $100,000 invested entirely in stocks. In a sharp downturn, the kind we've seen multiple times in the last 2 decades, a portfolio like that can drop 30, 40, even 50% in a matter of months. That's $30,000 to $50,000 gone on paper. And if you need that money during the downturn, it's not on paper anymore. It's just gone. Now say instead you held $70,000 in stocks and $30,000 in high-quality bonds. During that same downturn, your bond allocation, especially in government bonds, often holds steady or even gains value because investors flee to safety during panic, which increases demand for safe bonds and pushes their prices up. Your total portfolio might drop 25% instead of 40%. And this is the important part. You now have a pool of stable capital you can actually sell from to buy stocks while they're cheap, instead of being forced to sell your crash stocks at the worst possible moment just to cover rent. That rebalancing mechanic is the real superpower of bonds that nobody markets properly. It's not about the modest interest income, though. That matters too. It's about having dry powder that doesn't move in the same direction as your risk assets, giving you the ability to buy low precisely when everyone else is panic selling. The psychological root cause behind avoiding bonds is recency bias mixed with boredom aversion. Stocks have had an incredible run over the past decade, so anything that isn't stocks feels like it's missing out. But portfolios aren't built for the best 10 years. They're built to survive the worst 2 years without forcing you into a catastrophic decision. The people who blew up their finances in 2008 and 2020 weren't usually the people who lost money on paper. They were the people who were forced to sell at the bottom because they had zero stable capital to fall back on. The practical execution rule: your bond allocation should generally scale with your time horizon and your need for stability, not with what's trending on social media. Someone 25 years from retirement can afford to be far more aggressive than someone 5 years out. But even aggressive portfolios benefit from a slice of high-quality bonds, not because it maximizes return returns in a bull run, but because it's the insurance policy that keeps you from making a panic decision when the market eventually does what markets always eventually do. And here's the part I want you to sit with, because it's the piece that actually separates people who build generational wealth from people who build then lose it, over and over in a cycle. Wealth isn't just about the return you earn, it's about the return you actually get to keep. And you only keep returns you don't panic sell during a crisis. Two investors can earn the exact same average return over 20 years on paper and end up with wildly different actual outcomes, purely because one of them had a bond allocation that let them sleep at night during the crash, and the other one didn't, and sold everything at the bottom out of fear. The math of compounding doesn't care how smart you are, how many books you've read, or how confident you sound at dinner parties. It only cares whether you actually stayed invested when it mattered. Bonds, boring as they feel, are frequently the single biggest reason disciplined investors are able to stay invested through the exact moments that matter most. Here's the harsh reality. Nobody is coming to teach you this. Not your school, not your bank, not your employer's half-hearted 401k orientation video. The system doesn't benefit from you understanding bond math, yield curves, or the real mechanics behind your mortgage rate. Confusion keeps money flowing in one direction, and it's not toward you. So here's what you actually do tomorrow morning, not someday tomorrow. Step 1. Open a finance site or app you trust and physically look up two numbers, the 2-year Treasury yield and the 10-year Treasury yield. Just look at them. Note whether the line is inverted or normal. This takes 90 seconds and it will train your brain to stop being intimidated by these numbers. Step 2. Pull up your own debt. Every loan, every credit card, every mortgage. Write down which ones are fixed rate and which ones are variable rate. If you don't know, find out this week. This single piece of information tells you how exposed you personally are to future rate movements. Step 3. If you have any investable savings sitting in cash earning close to nothing, look into where high-quality short-term bonds or treasury bills are currently yielding. In many recent periods, short-term government-backed instruments have paid meaningfully more than a typical checking account, with government backing behind them. That's not a someday project. That's a phone call or an app tap you can make this week. Step 4. Stop treating the economy as a mysterious force happening to you. Start treating it as a machine with visible gears, and the bond market is the biggest gear in that machine. Every time you see a headline about the Federal Reserve, translate it in your head into bond language. Rates up, existing bond prices down, borrowing more expensive across the board. Rates down, existing bond prices up, borrowing gets cheaper. That single mental translation puts you ahead of the vast majority of people who just feel vaguely anxious every time the news mentions the Fed without understanding why. Step 5. And this one's genuinely uncomfortable. So I'm going to say it as plainly as I possibly can. Stop outsourcing your understanding of your own money to people whose incentives don't line up with yours. Your loan officer is not lying to you when they quote you a rate, but their job is to close the loan, not to teach you the mechanics behind the number. Your bank isn't lying to you when they offer you a 0.4% savings rate while short-term treasuries pay 4 or 5 times that. But their job is to keep your deposits cheap, not to send you somewhere better. None of this requires a conspiracy. It just requires you to understand that nobody in that chain is incentivized to make you smarter, which means you have to make yourself smarter, on purpose, starting with the 5 steps I just gave you. This isn't about becoming a bond trader, and it never was. It's about refusing to be the last person in the room who doesn't understand why the price of everything just changed, again, for reasons that were visible weeks in advance to anyone willing to look. It's about the difference between reacting to your financial life from a permanent state of confusion and actually seeing the gears turn before they turn on you. And look, understanding bonds is step 1, but bonds only tell you half the story of why your money moves the way it does. Everything we covered today explains the mechanics, the machine, the gears, the way rates ripple through your entire financial life, whether you're paying attention or not. But mechanics alone don't explain why perfectly intelligent, financially literate people still sabotage themselves the second real money and real fear enter the picture. Knowing that a yield curve inversion is a risk signal doesn't stop someone from panic selling their portfolio at the exact bottom anyway. Knowing the math on compounding doesn't stop someone from cashing out early because their neighbor is bragging about a stock tip at a barbecue. If you actually want to understand that other half, the psychological reason smart, disciplined people still go broke chasing the market even when they know the math cold. Go watch the video I made breaking down exactly that. It's linked right there on your screen, and it connects directly to everything we just covered today, because the two ideas were never meant to be separated in the first place. You can understand every bond mechanic in this video perfectly and still lose money if your own psychology sabotages you at the worst possible moment. Watch that next, because understanding bonds without understanding your own financial psychology is like reading half a map and wondering why you still got lost. I'll see you in that one.